Hi, everyone. This is Bruce Fleet, the president of Fleet Capital Management. Today is April 9th, 2016, and we're going to do a bit of a review of the month of March to take a look at the markets, what they're doing, how they're driving us crazy, and where we stand. As always, I need to begin with a short disclaimer which says if you are watching this video and not a client of Fleet Capital Management, please do not take any of the information presented herein as a recommendation to buy or sell. It's not. It's for informational purposes only. If you would like to contact me, always feel free. You can reach me at brucefleet@gmail.com or call the office at 360-389-6407, and I'd be happy to answer your specific questions about what is covered. With that said, and disclaimer out of the way, let's begin. I realize that when we do our video conferences, the camera's pointing at me, so you always see what's behind me and never what's on my desk. So I thought I might show you what my desk looks like. 3 live monitors, always monitoring different parts of the market that I'm studying at any particular moment. Big coffee mug to keep me awake. We start early in the morning, and a Bose sound system because I like to listen to jazz and classical while I'm trading. It somehow keeps my mind calm. But anyway, I thought you might enjoy that. So in talking about the market, and we can look at March, or we can talk about 2016, or as you'll see in a couple slides, we're going to talk about 2015, 2016. Is it me, or does this market feel like, I don't know, a roller coaster? That was the classic picture, I believe, after Superstorm Sandy hit New Jersey area. I believe that's where this picture came from. But I'll tell you, this market, I've been trading in the markets for 30 years now, and this has been the absolute craziest market I've seen, in that one day it goes way up, the next day it goes way down. It just seems like a sickening ride, so to speak. Now, will that end? Yes, of course that will end. We're just in this sideways period, and we have been in this period for quite some time now. And I think many of us, like riding on a roller coaster, would say it's time to get off. Let's go find a trend, because this up and down is not the most fun thing that we do. And like I said, even though we may feel sick, we really haven't gone anywhere. If you think back, I mean, we're in spring now. It's beautiful in the Pacific Northwest. Everything is blooming, and it seems like Thanksgiving was a long time ago. Well, let's take a look at a chart, and I'm going to open up a little drawing tool. Bear with me for 1 second. And so this is a chart of the S&P 500 index. And this happens to be a weekly chart. So each bar in here, or what we call candles, represents 1 week. That way I can make it go back further. What I want to draw your attention to is we closed last week at about 2061 on the S&P 500. And I mentioned last November, or Thanksgiving. If we go back, you can see November is here. We were pretty much in the same place that we are now. But wait, that's not the Thanksgiving I'm talking about. I'm talking about the Thanksgiving in 2014, which closed right about here. And if you just let your eyes go horizontally, you'll see that we closed Thanksgiving of 2014 at this level, and then draw a straight line over as best we can. We now have a reality that we are in a sideways market. And I've been talking about this ad nauseum for the last year or so, because that's really what it has felt like. It's just a sideways market. It's really not been going anywhere. Have we had some big down moves? Yes. Have we had some up rallies? Yes. And during these up rallies, it is very normal for us to think, hey, we're in a new bull market. Well, we're really not in a new bull market. We're just rallying back to where we've always been. That's not a bull market. A bull market is when we get higher than the last high and we can start to go back up. So that was just one thing I wanted you to think of, is that yes, this has been a nauseating market, but we really have not gone anywhere. And it is incredibly difficult to make money when the market is not behind you, as I'll show you in just a little bit. So let me close out of this. Again, bear with me, and we'll continue on. Maybe we won't. My slides just got stuck. So let's see. There we go. One more. There we go. So I was mentioning you're not in a new bull market until you break what I like to call the glass ceiling, which is the most recent or the highest high. Well, how can you see that? Well, one way you can see it is what I just showed you, that the market hasn't really gone up. But I want to introduce you to another tool that I use on a daily basis. It's called price by volume. And we're going to look at price by volume on daily and weekly charts just to give you an idea of what's going on with how we use this. So this chart that we're looking at happens to be a daily, if you see this over here, a daily chart of the S&P 500. And that means that every bar or candle represents one day. And here's where we were Friday, which was yesterday at 2060, just like we looked at before. And one way to see the glass ceiling is just to let your eyes do the work and kind of go back to where we were. But another way is called price by volume, and that's what these green and red bars are. And you see that these two bars are the two longest bars. So the way price by volume works is on each day, if it's a down day, it's red, and that corresponds to this off red, if you will, purplish color. If it's an up day, a clear candle, it represents to green. But that's not a volume. So the volume on an up day is considered up volume. The volume on a down day is considered down volume, even though during the day it goes both up and down. But what I want you to see is at this price level, from right down here to right up there, just this gap in price level is where the majority of volume has been for quite some time. We're looking back through last August. This was when the last downturn started. That this is where most of the trading has taken place. And what we're seeing, since we haven't broken above that, is that every time the price gets to this area, it seems to be an area of resistance, and it pushes the price back down. I hope I made that clear. This is a difficult one to look at, but that's what price by volume is. And if you take a look at the degree of trading going on here, and the fact, like I said, that we haven't broken through it to the north side, this looks like a ceiling. Let that continue over here, and you can see that if we drew a line, those volume bars would come in right around here, and this stands for resistance 1 and resistance 2. Another topic, but resistance is like a ceiling. And you can see what we say here is that there's overhead resistance in this area. You can see we got up to it and then we bounced back down. Then we got up to it and then we come back down a little bit. So when you have, and markets and traders have wonderful memories. They remember price. They remember what happened the last time a price hit a certain level. So think of it as a glass ceiling, that it really takes some power to break through it, to force through, and to continue or begin the continuation of a new uptrend. This was the last high, approximately in this area, and that's what we need to break through. So it's just another way to see where the ceiling is, and I hope that was clear. This is also the S&P 500, but this one that we're looking on is weekly. So instead of going back to last August, this one's going back to January of 2013. So we have a much longer, and we're doing the same price by volume. And you can see that both the daily and the weekly, if you follow that line across as best you can, this is the resistance line. And again, it's marked as resistance 1. This is what we need to bust through, and this is a weekly chart, but we need to break through that before we get out of this sideways trading range. And I showed you this chart without the price by volume before, that if we go back to November here, Thanksgiving of 2014, we're pretty much in the same place we are now. So we are in a sideways market, and throughout 2015, I suggested to you that I suspected a sideways market was developing, and now that looking back, it's always much clearer. But that's what we're in. And so this rally that we have seen since about the third week of February, or second or third week of February, has been very enjoyable until the last week, but it's also not to be construed as a new bull market. It's just a reaction back to the overhead resistance. And what we really want to see, if we want a new trend, if we want a new uptrend, we have to break through this level. That would constitute a new uptrend. There are a lot of people, a lot of experts around the country, around the world, that are predicting a long downtrend. I'm not sure I'm in that camp anymore, but we'll take a look at that and see how we read it. So another aspect to trading and clues, signals that we look for to try to figure out what's the market trying to tell us, and that's a really important statement. What is the market trying to tell us? Is we look at something called a volatility index. You may have heard of the term VIX, and VIX just means a volatility index. Now, the way to understand volatility is a down market, a bear market, works off of fear. Fear generally is short-lived but dramatic. So things are more volatile when the market is going down and less volatile when the market is going up. So what this chart is showing is I'm back onto a daily chart of the VIX. So these candles here, they're not stock prices. This is representing the volatility index. And then this black line that I overlaid on this chart is the S&P 500. And what I'm trying to show you is, as volatility declines, you see that decline right there of volatility, the stock market goes up. And as volatility declines, the stock market goes up. As volatility increases, stock market goes down. So it is converse of each other. Because I used a daily chart, it's a little bit more difficult to see. But just remember, if you are looking at the volatility index in the newspaper or online or ever looking at that, and I look at volatility index intraday, so I'm watching it throughout the entire day, you want to understand that they are working converse to each other. So this black line again is the S&P 500. As volatility was falling, S&P was going up. Volatility starting to go sideways, market starting to go sideways, and I just wanted to introduce you to that because I know a number of you do watch the volatility index, and that is something that I watch on a daily basis. So remember the old commercial? It was one of my all-time favorites where the little old lady said, "Where's the beef?" That is not really the question that we ask. We ask, where's the trend? Where is the trend? Because that's where we can make money, is in a trend. Stocks, I was actually talking to some clients in Colorado just the other day, and off the top of my head, I mentioned surfing. I don't know why, maybe because the weather's getting warm. And I said, stocks without a trend are like surfing without a wave. It's nice, it's relaxing out there, but not terribly exciting when there's no wave. This young lady's going to be sitting there for a very, very long time. Trend trading, which is what we do, is much more fun, and trend slash wave would look more like this. So a wave, and actually there's a technical analysis program called the Elliott wave theory, not to be confused with this magnificent wave, but you can think of it the same way. A trend is like a wave. I actually attended a technical analysis seminar back in, I'm guessing it was in the late 1980s, and I was out in Lake Tahoe with a couple of gentlemen, one in particular who I didn't know at the time was one of the greatest trend traders in the entire world. I believe his name is Ed Seykota. And Ed had a very humorous and interesting way of explaining his trading prowess. And like I said, he's the most profitable trend trader in the world, and he has been for decades. He said, I love to surf, and I may have told you this story, and he used to live in La Jolla area, which is also a magnificent part of the country. And he said, when I was out there on my surfboard, I was out there with a lot of really professional surfers who study the wave patterns and study the seaweed floating on the ocean surface. And he said, I wasn't into that. He said, I was just trying to reduce stress and get out there on the water and in the sun. So he said, I didn't do that. He said, what I did was when a wave came, I stood up. And so he equated that to his trend trading. He said, when a trend comes, I stand up, and stand up means you make trades. And that trend can be an uptrend or it can be a downtrend. When the trend comes, ride it. That's how you make money in the markets. So there's what I would equate to a trend as a wave, is another interesting way to think about it. With a trend or a wave, pretty much anyone can do it. This is my favorite picture that I found on the web. I love this little guy. I have tried surfing 2 or 3 times in my life, once in Florida, twice out in La Jolla, and I will tell you I'm as bad a surfer as I am a golfer. You want to put your money on the other guy, not on me. So I'm not a good surfer, but I do understand trends, and trends are like waves. So that's my type of surfing. So we've been in a sideways market for a very long time. It's been frustrating for a very long time. I can only imagine to you, the investor, it may be even more frustrating than it is for me, the manager, because I'm involved in it tick by tick, second by second, minute by minute, day by day. So I'm studying it. And sometimes when you're in the middle of the forest, you enjoy the study. But when you're not in there, you just want to know, why isn't my money going up? Or why am I not making more money? Or, there are lots of why. So I understand that frustration. It's hard to make money in a sideways market, but where do we go from here? Well, I can tell you with certainty we're going to go up, down, or sideways. That's the easy answer. The hard answer is deciphering which way it's going to go, and how should we be positioned, because we should be positioned very, very differently in a downtrending market than in an uptrending market, quite obviously. But we can make money in either one of them. In a sideways market, we keep putting our toe in. We're hanging out in the water, just waiting for a trend, and we're doing the best we can while we're waiting for that wave, which will come. The big money right now, I hate to tell you, is banking on a bear market. I am not sure that I'm in that camp right now. And in this business, as you have learned or will learn very quickly, is that there are no shortage of opinions in the investment industry. Zacks Investment Research is just one of the investment research companies that I subscribe to. So I buy their research, that means. And they're a big company out of Chicago. They're very, very well respected. They are not technicians. They're not in technical analysis. They're much more heavily weighted in fundamental analysis. And in previous webinars, I've explained the difference there. This was in my inbox this morning. This is one of about 200 slides and commentary that they do. But they feel right now that a bear market's the most likely outcome because the age of the bull market has been long in the tooth, if you will. This particular bull market started in 2009. So it's getting pretty old. We've got a lot of topping patterns. Remember I showed you the charts where we were hitting the glass ceiling and then rolling over. Those are topping patterns. Economic data is lower. That doesn't mean all of economic data. What Zacks is primarily looking for is earnings data. And you can see the next bullet point is earnings are lower. And they feel that stocks are fully valued. Now, I haven't done this, but I could show you a slide from other major research organizations that say the exact opposite of this. And you wonder, how can two of the leading research companies in the United States or even the world see the market in two different views that are 180 degrees opposed one to another? Well, the way you understand that is for every trade, and there are billions of shares traded every day. For every trade, you have to remember that there's a buyer and a seller, or you don't get a trade. The buyer feels that underlying security or stock is going to go up, and the seller at the exact same moment feels like the value of that security is going to go down. So that is the only way that I can think of explaining to you why two different research organizations can be diametrically opposed in their analysis. And that's because there's so much data out there for us to analyze. You really can create a legitimate story on either side of the trade. That's again, what makes this business so very, very difficult. Our job here at FCM is to let the markets, not the pundits, show us the way. That's an important statement. Our firm pays a good deal of money to get the information from these research organizations, lots of them, multiple research organizations and multiple analysts. We pay for all of them, and we have a steady stream of information. But I won't trade your account or your money solely based on what they say. What I do is I make the market show us the way, and that's really important. We will follow the market, we'll take a position, and we will always protect from the downside risk. If our indicators are, which I've shown you some in the past, are suggesting that over the next few days, weeks, months, the market, it should be strong and going up, we'll take a position, as we're in some right now, to hopefully ride that up wave to profitability. But we will always, 100% of the time, use protective stops and other methodologies to protect us if that wave fizzles out. And if any of you have ever done body surfing or regular surfing, sometimes you see a wave and it's coming, you're getting really excited, and you're paddling hard and kicking hard, and you catch that wave to ride it into the shore, and sometimes it just fizzles out. It just doesn't turn into a really great wave. Well, continuing on that same beach analogy, it's the same thing in the market. Sometimes our indicators are suggesting a positive trend or a positive trade, and it does fizzle out. That's why we will always 100% of the time do our best to protect on the downside. You may need to ride 10 or 15 or 20 waves before you get the great wave, the great trend that really goes for months and makes you a lot of money. That's how we trade. But there are going to be all those other waves that fizzle out, so we have to protect ourselves on the downside. You want to trade when the odds are stacked in your favor. And when I say trade, I mean either up or down. And I've shown you in past webinars numerous indicators that I use. And I've planned on the next webinar we do next month to show you the most recent set of indicators that we use from Rahul Mohindar out in India. I've mentioned to you that he and his company and I have been talking a great deal and fine-tuning some of those indicators to be able to get data and see if it's stacked in our favor. I think I'm going to do that on another webinar. So you trade when the odds are in your favor, but it doesn't mean you're always going to be right. You also don't swing for the fences until a clear trend is in place. I've received a few phone calls from some clients who have said, I think I understand the entire trading methodology, but I've noticed that we're only about 50% invested and we've got 50% in cash. Well, that's because we don't have a clear trend yet. I can tell you when we have a clear uptrend, we'll be 100% invested. If we have a clear downtrend, again, we may be 100% invested. In a sideways market, we keep sticking our toe in the water because we don't want to expose ourselves to too much risk, even though we have the risk controls in place. So you don't swing for the fences until a clear trend is in place. This is a picture I took on my iPhone. Last night, I was at the Seattle Mariners opening day or opening night, and it was fantastically fun and ridiculously crowded and expensive beyond belief, but that's pro sports on opening day. You can see I'm not a master photographer. If you look at the bottom of the picture, you'll see I captured some guy's back of his head in my frame, so sorry about that. So just remember, and your takeaway from this is that you'll make money in an up market and you'll make money in a down market, but man, it's hard to make money in a sideways market. You just can't do it. You can't surf if there's no waves. Next month, I'm going to introduce you to that trend analysis system that I mentioned that I work with Rahul on, because I think you'll find that interesting. I will dig into another piece of our technical analysis, the numerous pieces of a technical analysis that we use here, because I like you to understand those things. But with that said, these monthly webinars, they're for you. They're not for me. So please feel free to call me or send an email and say, hey, Bruce, on one of your webinars, I'd love you to talk about this, or I'd love to better understand this part of the system. Again, all of this stuff is for you. It's not for me. So please reach out to me and let me know what would help you with your education. Another thought is, prior to these monthly webinars, we were doing quarterly reviews. That has slacked off a little bit. I'm starting that back up. It may not be quarterly. It may be 3 times a year, because I don't want to inundate you too much, but I will send you an email over the next couple of weeks to find out good dates and times, because I still think it's important that we have face-to-face time on the video conferencing and we really touch base. And if I haven't reached out to you and it's been a little while and something's coming up and you want to talk to me, again, shoot me an email and we'll immediately put it on the calendar. And that's always available to us every day, anytime that's convenient for you. So again, if you feel like you haven't had a chance to talk to me face-to-face, just shoot me an email. But I am starting that back up. I have met with a few clients so far, and I'm kind of rolling that back out over the next couple of weeks. So that's the story for this month. I hope this was interesting. I hope it was helpful. As always, if you have a question, shoot me an email. If I receive the same question from a number of people, or a question that I think will be valid for everyone, I'll respond in a blast email back to everyone. And that's a story. I hope you are enjoying spring wherever you are around the country. We've got clients all over the United States. It sure is beautiful out here, man. It is beautiful in the Pac Northwest right now. Enjoy your spring. Try not to get too caught up in the markets, and as such, try not to get too caught up in the insane politics that we are all seeing. It doesn't matter what side of the political spectrum you are on. I think it's safe to say we are all pretty disgusted by what we're seeing. This too shall pass. Our country was founded on good thoughts and good values, and in there sometimes it gets messy, and we're in a messy time right now. So enjoy your day. Shoot me an email. Let me know how you're doing, and I will talk to you soon. Bye-bye.